Hello, and welcome to another day of TA the Degen Way. Well, I just wanted to hop on and talk about something I've brought up in a couple past videos, which is what I keep referring to as the Octave method of measuring past price action for future areas of interest in both time and price, that if price ends up there in price, there's a high probability for a reversal. And because price did something in the past, there's a good chance that it may end up there. Or if a certain amount of time, like in this chart here, passes, there is also a likely reversal. Or like these weekly Bitcoin time cycles. If we look at these things, they, have the potential to be extremely accurate, but are never anything that can be relied on by themselves. I mean, all this is really telling us is that price has deviated a significant way from the average. So if we look at like this gold chart, like these time cycles that are on here and these price levels, I mean, there's 100 ways to show the same thing. You can see there's a nice breakout there. Or if we look at this old Bitcoin chart, I mean, why do these time cycles have any significance at all is not super complex, and what I want to show you here in just a second. Oftentimes I demonstrate these things on the 1 minute, just showing how just one deviation in a trend is just essentially repeating itself over and over and over again in one form or fashion into the future until that trend ends. And while it doesn't tell you what price is going to do, when price is giving you a reaction in those areas of high probability, you can use those things to your advantage when making decisions. So like right now, I mean, I know that price has risen a certain amount and moved over a certain amount, that a reversal's kind of likely. I mean, it doesn't mean it's going to end up down here, but it may end up down here or down here, and it's just not a good time for me to press the buy button. So what is the Octave method? It is nothing more than, if we go to our Bitcoin chart here, if we take a trend from the beginning, and all that matters is the extremes. When price was at the extreme, and it changed. Well, why did the price change there? Well, it's because it deviated far enough from the average to actually get a change, started a trend, and that trend persisted just from, a feedback loop of people pushing it in the other direction. And after a certain amount of time, the people that are willing to support the trend is diminishing just the same. So if we take, let's take just our last trend. Here's pivot low, pivot high. Here's the extremes. Think of these as zero. And I use the fib retracement tool, and I start at the low right there. And I've taken my fib retrace tool and I've changed the settings on it to just give me 1/8 increments. Why 1/8 increments? Well, there's nothing special about 1/8 increments. They're just equal proportions. I mean, hence why some people refer to it as the Octave method. Goes a little bit farther than that. But really, for us, all that matters is, here is zero, right here. This is one deviation from zero. So when price moved this far from balance, it stopped. It took this amount of time, this amount of price rise for that one deviation from that pivot. So now in the future, in this trend, you can see that price responds to these levels. And oftentimes, if you set this at 1/8 increments, you will find that you see reversals in the golden zone of 50 to, 61.8%. And I set this at eighths, so at a lot of times at the 0.625 level, that will be the top. But really, all this is telling us is that, here's 1, there's 2, 3, 4. These are areas that, essentially, just act as a magnet. Here you have support, resistance, support, resistance. This is all the farther that buyers are willing to push price before they dwindle away. Essentially, and it's just one deviation in the trend. And now you can use this for both time and price. And there's nothing magical about these things. It's just showing us that price has moved this same amount up and the same amount over, whatever that ratio is. And we can take time measurements by well, first let's just look at this right here. Here's the low, here's the high. So the high bar is 43,870. We'll say 43,873. This is at 43,890. Well, that's close enough. None of this stuff needs to be exact, because you're not using this stuff to make exact predictions and forecasts. You're using this to give you high probability areas of interest, because prices moved a certain distance in time or price away from right there, or away from this one, or that one. So let's mark out. Here's the high right here. Let's mark that. Let's mark that high and start transferring some of these values, or this ratio right there, out into the future. We can grab our trend line tool and start right there at the low. We can start giving ourselves some areas we're on the daily. This isn't going to actually tell us anything. We would need to get in here and take this most tiny little range. We could take this right here and we could just match it to the price action. So here's a trend line. And why does a trend line exist? Because price is increasing. If we just took the center of this trend, the size of that deviation is just getting a little bit larger. So as price reaches that extreme, chances of reversal just become much higher. You can see, they're equal portions on both sides. So when these things converge, price is coming up to this time-based value right there, and this price-based value right there. And if you're getting reversal signals, like if you come down onto the smaller time frames, it looks kind of like a good place to enter a short. This looks like a kind of a good place to have taken a short. Kind of looks like a good place to have taken a short. That looks like a kind of a good place to have taken a long trade. So does this horizontal. This looks like a good spot for resistance right there. Same thing way up here. It's your support and resistance on these smaller time frames. It's just, that's the size of a deviation. We're just transferring that out into the future. That ratio. Now another thing that we can do is we can get rid of these angles. And we can start at this pivot low Here's the amount it went up. Here's the amount it went over. Let's get it right on the actual high. Which is right now that we were on the daily when we set that line. Now we're on the hourly. So let's grab our circle. Let's start right at that low. Let's pull our circle up to this high. Now, as of right now, this means nothing because, I mean, of this right here. We've adjusted it for the height, but we need to adjust it sideways. So now this right here is showing us this relationship. This is this same relationship in larger space. Let's slide her up the chain, you know. They're just high probability areas in time and price that you should be looking for a reversal. Notice how that comes out right on that reversal bar. You know, it's got a higher high and a higher low. Same amount of space on this side of it, same amount of space on that. It's right dead smack at the change of trend. You know, it's a probability thing. You've deviated a certain distance in time, or deviated a certain distance in price. There's not exact, you know, it's awfully darn close. You know, it's giving you an area of interest, which is why, I mean, it should never be just a hard bar line. But oftentimes, too, I will see that, I mean, you know, there will be a top at that 5/8 mark. And if you move your time factor to the 5/8 mark, a lot of times that's giving you a top also. Or you could, you know, go all the way to the top of that scale. And part of the reason why a lot of times I use eighths is because, you know, I mean, it's a lot of times gives you kind of the, you know, the exact top, you know. So that's the octave method. You can use this to just take this here's 0, the pivot high or pivot low. Here's the first range, that impulse range. Right there. Here's the amount of time. You can duplicate this going up. You can duplicate this going over. And, I mean, all that is really going on is, you know, I mean, if this guy doesn't look familiar, it should, you know, it just should. Here, let's look at this trend right here. You know, you're at the extremes of probability. So that's the octave method, and I mean, the only predictive power that it really has is that when price is in those conditions, the chances of reversal are far more likely. So you can use it for forecasting, you know, areas of high probability to look for a change or a reversal. Well, that's all I got for you. If you have any questions about it, you're always welcome in our free Discord, where I talk about these things pretty much every day, all day long. And you can use these on any time frame, to analyze any trend. You know, it's one deviation in the trend. But you're welcome to come into our free Discord, or check us out on Twitter. There should be a link in the description to the Discord. We'd be glad to have you. But until next time, trade well.